Hey everyone, and thanks for jumping back into the macroverse. Today, we're going to look at all of the prior recessions going back to the 1940s and making some comparisons with them to inflation and with the S&P 500. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and check out the Into the Equityverse Telegram channel, which you can find a link to in the description below. Let's go ahead and jump in. So we do occasionally take a detour from the cryptoverse, which is where we spend a majority of our time. Perhaps we fell through a black hole and we found ourselves in the macroverse, which isn't the worst place to find yourself when you're sort of navigating a bear market and you're trying to figure out, when will things turn back around. We know that crypto is a very risky asset class, and in order for it to do well, we need good macroeconomic conditions, and so this is why we're covering this in quite a bit of detail. So the white line on this chart is inflation in the United States measured year over year. And there's definitely a few distinct peaks when you look at this, okay? You can go back all the way to the 1940s right here. In 1942, we had inflation at 13% year over year. In 1947, we had inflation at about 20% year over year. And then in 1951, we had inflation at about 9.3 or 9.4% year over year. We saw similar periods like that in the 1970s as well. Now, the green shaded regions are when I went back and looked at all the prior recessions, I then put them on here. Okay, so the green shaded regions are all of the prior recessions in the United States. I don't believe I missed any. It's always possible that I did, but I don't believe I missed any. And I just wanted to see how periods of high inflation correlate or correspond to United States recessions. Now, one thing to consider with regards to recessions is that there's not really a clear-cut definition as to what constitutes a recession, at least perhaps not anymore, right? I mean, I think technically speaking, a lot of people would point towards things like, two quarters of GDP contracting. We've already had that, but a recession still has not been declared, probably because unemployment is still relatively low. But regardless, suppose that we just sort of humor this idea that we're not in a recession yet because unemployment is low. I'm not asking you to agree with it. I'm just saying let's just pretend like, okay, well, if that's what it takes to cause a recession, then, is that a likely outcome from this point, right? It's just, is that a likely outcome? And what I look for in this situation is I say, well, has there ever been a time when inflation went above a certain level that a recession did not follow in recent history? I mean, looking over the last 80 years or so, and let's just pick a line in the sand. We could pick 4%, maybe 5%. Let's make the line in the sand between 5 to 6%. Okay, so what we're going to do is we're just going to look, and I'm going to shade this a different color just so it shows up just a bit better. Now, what I'm interested in is, has there ever been a time where inflation went to at least 5 or 6% and then a recession did not follow at some point, either during that phase or shortly thereafter? And if you go back and you look, this first period up here in 1942, we had a period of very high inflation. And in order to get it down, we did in fact eventually get to a recession. Now, we were not technically in a recession when inflation was high, but the economy slowed down and then it led to them declaring a recession eventually. Okay, so yes, when inflation year over year went up to about 13%, eventually we had a recession. All right, and to give you an idea of the time frame on that, you can see that this sort of peaked. Inflation year over year peaked over here in July 42, and then we had a recession a few years later. It was in 45 or so, and then we had another peak of inflation in 1947, and then a recession was sort of declared for parts of 1949 or so, and it wasn't really declared until after inflation was coming down quite a long period. So what you notice is that so far, in order to get out of these periods of high inflation, it does tend to lead to a recession where unemployment is going up and, of course, the economy is slowing. It doesn't always happen as quick as we might think, right? It doesn't always happen as quick as we might think. If you were to just say 2 quarters of negative GDP, you could argue that it's already happened. But if you take a more fluid definition of it, a little bit more arbitrary, hand wavy type of a definition, you could argue that yes, a recession could come, but it still could be a little ways off, defined by looking at things like the unemployment rate, or maybe a year or so off. And then if you look at 1951, period of high inflation, in order to really get it down, we eventually had a recession. And this recession was in mostly 1953, after having a period of high inflation that peaked in May of 1951. And then so on and so forth. I mean, you can see that the next time we really went up to a period of high inflation, it corresponded to a recession. In order to get it to come back down. This was in 1969. We saw the same thing in 1974. Again, both of these times, inflation went up, and we ended up having to have a recession in order to get inflation under control, where it went down for a while. Unfortunately, the 70s was basically remembered as an inflationary decade, and I've talked to a lot of people about it who were alive back then, and they were talking about how just the early 80s is really when they remember just inflation being very, very just very high. And I think too, they had been living through it for like a decade, so there really was no reprieve from it. It was just essentially going all the way back to 1965. Inflation was just sort of putting in higher highs and higher lows, and then it finally topped out here in the early 1980s, thanks to the former Fed chair Volcker. Okay, and he caused, by raising interest rates to very high levels, he caused 2 somewhat short and sweet recessions. A lot of people didn't like him for doing it, because it was very painful to businesses, but arguably it was necessary to do to get us out of that decade of high inflation. So it was, did he have the courage to do it? And he did, despite what people thought of him, and it got things back under control. And now that's how he's remembered. He did not fold when the pressure came. And again, you can see if you go even further into the 90s, we had a brief period where inflation went up, and then a brief recession to get it under control. There's also periods where inflation maybe goes up to 3 or 4%, and then we had a recession that eventually got it under control. And then over here in 2008, you can see that inflation year over year got to about 5 to 6%. And of course, we had a recession. It got things under control. We also had a very brief one in 2020. Okay. However, it was relatively short-lived because they turned the money printers on. And this one wasn't really caused by inflation. It was caused by the black swan. But by sort of printing all that money that we printed over here and over the next couple of years or so, it's led to so much more money in the system that now inflation has gone up a lot once again, to the highest level it's been really since for the last 40 years, not since 1982 or 1981 or so was it at these levels. And so then the question becomes, will we have to experience a recession in order for us to ultimately get out of this? And history tells us the answer is yes, right? That's what history says. Now, remember, a recession does not always mean that the stock market has to go down, okay? It does not. A lot of times the stock market could bottom, before a recession is declared, or maybe slightly in right after it. But in order to really look at that, we need to go ahead and overlay the data. So this line here is the S&P 500, and I'm going to go ahead and remove some of these little squiggles off the chart so it becomes just a little bit more clean and it's not as hard to read. But what you'll notice is the S&P has just more or less just been trending up with time. Okay, so yes, there's phases where a lot of people freak out and wonder, what's going to happen. But no matter what has happened, going back for the last 100 years or so, the S&P 500 just generally trends higher with time. This is something that a lot of investors have come to really rely on. But let's zoom in and look at some periods where there was high inflation and see kind of what was going on. Well, if you look back to the 1970s, this is one of the things I've spoken about. And this is where the nuance is, okay? You could look at this phase right now and compare it to the 40s, or you could compare it to the 70s, okay? You could, in terms of just being a high inflationary period. And if you look at when inflation year over year peaked, it corresponded to when the S&P 500 bottomed. That happened in the 1970s, and it also happened over here in the 1940s. Okay, so both of these times when you sort of had that initial run of inflation to 8, 9, 10% or higher, whenever it peaked is when inflation year over year, or sorry, it's when the stock market eventually bottomed. Okay. Now, what's interesting with these two moves is that the stock market really fell about 50%. This one was actually more if you take it from further over, but if you sort of just take it from this recent, a more recent drop, it wasn't quite as bad. If you go look at say what happened in 1970 when the stock market dropped from when inflation started to go up, right here, that was about a 50% drop or so. I know it says negative 173, but it's just because it's looking at this other scale over here. So I won't even use that. But both of them were about a 50% drop. Okay, so this one over here was about a 50% drop, and then this one over here in the 70s was also about a 50% drop. And what's interesting though is that during those periods, inflation year over year went quite a bit higher. Okay, as they were defining it back then, right? It went all the way up to like 12% or higher. Right now, we've gone up to 9.1. We're back down to 8.5. There's some speculation that inflation year over year has already peaked. I would contend there is a chance that it already has peaked, right? I mean, there is that chance that inflation is sort of starting its move down. Just because we went to 13, 14% in the 40s and the 70s doesn't mean we have to go that high this time. It could come sooner rather than later. But the thing to consider, I believe, is that there are periods where you saw sort of initial periods where inflation went up, but the stock market did not bottom when inflation peaked. Okay, so for instance, if you were to look at some of these more mundane peaks in inflation, this one went to about 5 to 6% in 2008. You could argue, well, that was a period where inflation peaked, but by the time it peaked, the S&P was sort of sitting on a cliff right before a catastrophic failure or a catastrophic drop in the stock market. You could also point towards the year 2000 or so and say once the inflation started to finally roll over here, it wasn't at a stock market bottom. We still had a fairly sizable drop to come. Okay, so with that in mind, we need to take into account all of these different factors, right? I mean, there is a period right now of high inflation, but we're also seeing things like the 2-year has gone above the 10-year, and so on and so forth. So I think that's an important thing to consider, and I believe maybe I can pull that indicator up if I have it on here. If I don't have it, then I clearly won't be able to. I can't remember if I saved it or not. Maybe I caught it. Actually, I think I caught it testing. So let me see if that works. So yeah, so here is the yield curve, okay? And you can see right now again that the 2-year is well above, say, like the 10-year. Okay, so well above meaning it's inverted, and a lot of people have sort of gone back to being risk off right now, especially if the yields continue to ultimately go up. But when I look at this chart, I try to figure out, okay, well, what does it mean for me as an investor over the next several years? What are some things that I could expect? What are ways that I could temper my expectations? And what I want to see is, and this is just my own biased, selfish goal, is I want the Fed to remain hawkish for as long as possible to get inflation down, because it's only after that I believe the stock market can go up in a sustainable way, okay? In a sustainable way. And I've gotten in trouble, I think, on this channel with using the word sustainable before. Back in 2019, I said it would take until potentially early 2022 before Bitcoin would see a sustainable 20K. And then I had to spend all of 2021 sort of wishing I hadn't used that terminology. But it's funny because at the end of the day, Bitcoin did in fact come back down to around the $20,000 level all these years later. And in fact, if anything, my prediction of early 2022 to see a sustainable 20K was too conservative. Or no, it wasn't conservative enough, I mean. Because clearly now it's mid 2022 and we're still, we still sometimes go below 20K, and there's a serious risk we could have another leg down in crypto. So that's something to consider. When we talk about these things of being like sustainable or not, it doesn't mean you can't have a deviation for a while. It doesn't mean that the market can't be irrational for a year or more. But if we're looking at this chart, what do we see? We see that during periods of high inflation, like in the 40s, in the 70s, the stock market was relatively humdrum, right? I mean, this is not that interesting of a stock market. I'm going to delete some of this stuff so we can see it just a bit better. But I want you to imagine you're an investor in the 70s, and you're looking at the stock market and you're probably wondering like what is going on? It's putting in higher highs and it's putting in lower lows. And you might look at this and say, well, this isn't so bad. But look at the time frame on this. This period started in 1964. 1964. This high here was in 65. The second high was in 68. The third high was in 72. It took, after we put in this initial high right here, we weren't really back into a bull market until the 80s. Why did we start going back up a lot in the 80s? Like this. Why did we have this secular bull market? One of the reasons, I think, is look, inflation finally got under control. That's what you want to see. It finally came down. It wasn't trending up anymore. And this is what we want to see. The stock market just boomed during that period of time. Now look at the 70s, look at the 40s. If you look at the 40s, we had periods of high inflation. And it really started over here. I mean, inflation still went up to like 5 or 6% if I were to expand this. And the stock market was relatively humdrum for a while. And then finally, it started to go on a secular bull market after inflation was finally under control. Now, going back to what I talked about earlier with Volcker and in the early 1980s, it took this, right? It took a recession, took 2 recessions at the time to finally get things back on track. Did it suck at the time? Yeah, because the stock market came down again. These investors must have just been absolutely, just completely dumbfounded as to how a whole decade could pass and stocks weren't really trending that much higher. It finally took the resolve of someone who meant business to get things back under control and for the economy to start doing relatively well again and for stocks to go up. Okay, so a lot of people say, well, when's the Fed going to pivot? I want the Fed to pivot. You don't know what the implications are, I think, if the Fed pivots too soon. Maybe it helps you out in the short term, but it could lead to a period of several years where the stock market stagnates, the economy just sort of stagnates, and that could be very challenging for investors because it's just not it's not a really great trend to just sort of go up and down and up and down. Now, for traders, that might be a trader's paradise, but for long-term investors, that's not really a great period for investing. So it just sort of just goes up and down and up and down. Now, where we are today, inflation is at about 8.5% year over year. And there are some signals that it is starting to come back down, right? I mean, oil is coming down a little bit. I don't know if it's going to continue moving higher or not. It has bounced a little bit recently, but then it came right back down to around $90. So we'll continue to follow that. There are other things that are coming down as well, but there are other things that are going up. So I think it remains to be seen yet if inflation year over year has peaked. I do think there's a higher probability now than there was back in March. But if it has peaked, remember, if this phase is not similar to, say, the 70s and not similar to the 40s, where it's going to go up much higher, then it might be worthwhile to just compare it to things like the dot-com crash or the financial crisis, which, I mean, we're completely different animals, okay? But the stock market still did go down after inflation peaked. I mean, this one still peaked at around 6% or so, and the stock market was not done dumping by the time inflation peaked year over year. One of the reasons you could argue that the stock market bottomed over here when inflation peaked is also because inflation, I mean, it just went up so high, over 10% year over year. And both of these times in the 40s and the 70s, during that initial spike upwards, the stock market had dropped 50% already. It had already dropped 50%. So these are important things to consider when trying to identify if risk assets are worth certain amounts of capital or not. I mean, this is not financial advice. I'm not trying to tell you what to do. I just want people to understand the implications of periods of high inflation and how it typically takes a recession to get things back under control. And if you look at prior recessions, if we were to sort of go through some of them very, very quickly, because I know this video is getting kind of long, and you're probably wondering why you're still listening. But if you look at some of the prior recessions and you compare them to the stock market, this one right here, this recession right here, the stock market was going down. This recession here sort of corresponded to, it was right before the stock market bottomed. The stock market had a nice little pullback right here during this recession. During this recession, the stock market pulled back as well. This one, it was not really much. This one had a pretty big pullback during this recession. So did this one, and so on and so forth. What you notice is that these recessions aren't really accustomed to the stock market going up. Maybe every once in a while you'll see it, but for the most part, when we're in a recession, the stock market is not doing so well. But here's the thing: by the time the recession is declared, the stock market could have bottomed, or it could be close to bottoming. So you might see at some point in the next like 12 months or something where there's going to be headlines that say, the United States is now in a recession. And then a lot of people who don't really invest much, or maybe they're just sort of fringe investors, they might say, oh gosh, we're in a recession now. It must be bad for the stock market. It's time to sell. Really, once once we're in it, once it's been declared, usually it's looking back, so it could go back a couple quarters or something by the time they declare it. But usually by the time it's declared, the stock market correction is either over or it's getting relatively close to being over. And I think it makes sense. The reason is because once it's declared, again, what politician wants to be in office during a recession and not be doing anything about it, right? So once a recession is declared, I think it would put a lot of pressure on the Fed to, in fact, pivot and to get inflation, and to really start printing again. The thing is we need to get inflation under control before we reach that point, in my opinion. If I overlay unemployment one more time, so I just want to I did that in the video yesterday too, but if I overlay unemployment again, this is still relatively low, but I would guess it's going to start going up over the next like 6 to 12 months. Okay, it's probably going to start going up. So I think about it like this: we need inflation to come back down before unemployment starts going up. Because if inflation comes down, right, like if inflation comes down and then eventually unemployment goes up, then the Fed could pivot in victory with regards to inflation. And yes, maybe we have to spend a little bit of time at 3 to 4% or something with inflation year over year, but it's a lot better than 8%, right? And hopefully it's on the track to where we want to be. The problem I see is what happens in a scenario where unemployment is going up, but inflation is either still going up or it's going sideways or something like that. Okay, that is not a situation we want to be in. So going back to the stock market, one of the things I've mentioned before is a soft landing versus a hard landing. I don't know if we're going to make it to these levels, but I think around a 3,400 plus or minus $100 or something, right? What's $100 among friends? Somewhere around this level is what I would consider to be a soft landing, meaning the stock market will have come down 30% off the all-time high. Okay, about 30% off the all-time high, and there should be some buying there. Coming down 30% is a long way to go down, and I do think some more risk-averse people would start to allocate more capital to the market. I mean, first of all, there's no guarantee we even go down to 3,400. Let me be clear. But let's just assume the scenario plays out. The only way I think that we can really have a soft landing is if, again, inflation gets under control before unemployment starts going up. Because if it doesn't, then I don't know how we're going to achieve a soft landing. Okay, I mean, like imagine a scenario where unemployment is at like 5 or 6%, or something, and inflation is at 6 or 7%. How can the Fed print money, right? If inflation's still sky high? So that's where things could get pretty bad. So, I would consider really anything below a 30% correction to be a hard landing, a 50%, a 40% correction, or a 50% correction. Remember, in the 40s and the 70s, arguably we had hard landings. Okay, I mean, remember the 70s, that this major sell-off right here when inflation spiked was 50%. This was a 50% correction, and then we saw the same thing happen in the 40s as well. It was about a 50% correction or so. We've also seen two 50% corrections, one here in the dot-com crash and then in the financial crisis as well. That's what I would consider a hard landing, like a 40 to 50% crash from the all-time high. A soft landing, I think, would be about a 30% crash from the all-time high. So if the stock market comes down into around 3,400 or so, and it's able to sort of hold that as support, I think that the Fed would have had to have accomplished bringing inflation back down before unemployment goes up. If unemployment goes up while inflation is still high, then they're more likely to look at a hard landing rather than a soft landing, as dismal as that might seem. But anyways, I hope you guys enjoyed the content. I'm trying to do a little bit better of a job of going into the macroverse and trying to look at some of these longer term trends. I'm certainly not an expert at it. I don't claim to be, just trying to look at the data and show you what it says right now. Right now, unemployment is low, using the metrics I use, right? Inflation is still high, and the stock market is sort of in this, intermediate phase of, it feels like it wants to eventually go lower into a soft landing. But the only way I think we can achieve a soft landing is if inflation comes back down before unemployment goes up. We don't want to find ourselves in a situation where inflation is still high, unemployment starts going up, and then the Fed has to figure out what do they do. There's not really a good decision there, because if they turn the money printer on, it's just going to lead to an inflationary decade, likely, just like we had in the 40s and the 70s. And if they don't turn the money printer on, then things are just going to get worse in terms of where the stock market is going. And then eventually they would get to the point where they have to pivot, right? I mean, the economy would just be so bad they'd be forced to pivot, and hopefully that would also correspond to finally bringing inflation down as well. But anyways, I hope you guys enjoyed the content. Make sure you subscribe if you're not subscribed. Give the video a thumbs up. Also check out Into the Equityverse Telegram channel. You'll find that in the description below. And then also remember to check out Into the Cryptoverse Premium at intothecryptoverse.com. Thank you guys for tuning in. Subscribe, and I'll see you next time. Bye.